I wanted to share with you just some quick thoughts about where the industry is headed to help set the stage for the meeting. Our industry as it sits right now reminds me of the opening lines of A Tale of Two Cities. It was the best of times, it was the worst of times. To be a little less literary, we're still sitting in the eye of the perfect storm. And the irony of this perfect storm is that while demand for our furniture and goods has never been stronger, our ability to meet that demand has never been more tenuous. Our biggest asset, a seamless supply chain, is once again our biggest liability. Even before the pandemic, it was fragile and it was often knocked offline by price hikes, worker shortages, driver shortages, container price hikes, raw material spikes. Now they've all hit at once, and they've hit us harder than I can ever remember, thanks to the pandemic. Oh, and let's not forget the impact of the usual disruptions we get from Chinese New Year. It's been more than a year since the pandemic reared its ugly head, and while on one hand, vaccines are rolling out, it's a slow process, and on the horizon we're facing mutant strains of the virus said to be easier to catch and harder to treat. In our arena, demand will continue to far outpace supply. Trade shows, as we've known them, are likely to change not only dates but format. Just look at First Tuesday, you know what I'm talking about. The supply chain, my prediction is going to limp along at least into the third quarter. Container costs are going to continue to be prohibitive. Traditional furniture retailers are going to be so busy in survival mode, they may not hear the ongoing sounds of e-tailers taking bite after bite out of their business models. And reps, our members, will need to learn to become problem solvers, not order takers, like never before. Near term, change is likely to be our only constant, and anybody who tells you otherwise or that they've got a crystal ball is also probably selling bridges in Brooklyn and carloads of snake oil. So what do we know? The furniture industry in the United States is well poised to continue its growth trajectory, especially after it's witnessed a boom in sales during the third quarter. A survey just conducted by our friends at the Home Furnishing Association in collaboration with Piper Sandler companies determined that furniture retailers saw an average 8% sales growth year over year in the third quarter, compared to a decline of 8% in overall sales in the second quarter. They're also calling for an overall growth of 15% on average in the fourth quarter, even though some written orders from that third quarter were pushed into the fourth owing to supply chain issues. So in a way, we should really thank COVID, because it's forced this stay-at-home and social distancing mentality that were put in place to curb the pandemic, and they've changed the needs of people and changed them largely in our favor. Finding themselves literally trapped at home, thousands of consumers felt the need to upgrade or modify their home furnishings as they began to stay and work from home, and that has been a big benefit to us. But traditional retailers are not the only channel cashing in on this trend. As the pandemic forced brick and mortar stores to shut down to avoid the risk of spreading the virus, online sales of furniture continued to spike. In fact, the survey that the HFA did found that online sales during the third quarter surged a whopping 210% over the same quarter a year ago. The health of the home furnishing sector has always depended on a strong housing market, and we have no gripes there. The Commerce Department reported recently that single-family housing starts rose 0.4% in November to a seasonally adjusted rate of 1.186 million units, which is the highest average level since April of 2007. The article further mentioned that this was the 7th straight month of increase for single-family housing starts, as pent-up demand along with ultra-low interest rates aided to that gain. Existing home sales are also hot and continue to register year-over-year gains for November. The National Association of Realtors stated that single-family homes for November were up 25.6% from a year ago. Notably, per a forecast from Realtor.com, single-family starts are projected to grow 9% this year, while existing home sales are expected to grow 7%. That can only bode well for us. And I also think this work from home trend is set to continue next year as well. According to a just released report by Global Workplace Analytics, 25 to 30% of the workforce is expected to work from home for multiple days a week by the end of this year. Really quickly, here's some external trends that I think we're likely to see this year and moving forward. I think unemployment rates will continue to improve. They're currently at 6.3%, down 0.4%. I think lending standards will continue to loosen. There's going to be a permanent shift working remotely. I think low interest rates will stick around. There will be more government spending and subsequent national debt. I think the number of renters who are unable to buy homes right now will rise. I think consumers will start to leave big cities or rent new homes in more suburban areas. Inflation is going to increase and home prices will continue to rise, especially in the affordable range. And a combination of higher transportation costs and spot tariffs will continue to impact the cost of goods and services, ultimately driving prices up. So what do all these paradigm shifts mean for us? Simply this: IHFRA cannot be the same old IHFRA ever again